Listen closely. This is the lesson 1929 tried to teach us, and the one 2026 will punish us for ignoring. The market is not a mystery. It is a pattern of human psychology and over-leveraged debt, repeating itself with ruthless precision. But the rules of escape, that is where the game has fundamentally, fatally changed. You are obsessing over, if the crash is coming, they tell you to focus on the terrifying certainty of how you will be trapped when it does. The cheerful pundits and the brokers pushing product want you focused on valuations, debt, and the predictable cycles of boom and bust. But that is the secondary concern, the smoke from the fire. The existential threat to your capital is something far more insidious, something the system designed after the Great Crash, a mechanism that turns your sensible urge for self-preservation into an act of self-destruction. The question that separates the operator from the lamb today is this: can you still get out when the alarm sounds? I tell you plainly, the answer is no. Let's begin with Livermore's first principle of survival. The pattern is predictable. Immediate action is paramount. Picture the man in September 1929. Hat on, cigarette burning low. He sensed the dread, walked into his bank, presented his passbook, and withdrew every dollar he owned in cash. He was free. 2 days later, the markets collapsed with violence that would echo for generations. The problem in 1929 wasn't the panic. The problem was hesitation. If you saw the pattern, the exit was open. You could walk in and request your full balance. Same-day withdrawals were standard. If you owned shares, you held physical stock certificates, tangible property that could be sold with a predictable 3-day settlement, not subject to indefinite trading halts. The man who survived acted on instinct, took his money and got to safety without needing permission. His destruction was his own decision, not the system's lock. But what if I told you that in 2026, even if you see the entire catastrophe coming, you won't be allowed to leave? The modern financial system learned its lesson from the bank runs of the 1930s. It has surgically, methodically, sealed the exits that saved my generation. The rules have changed and you are playing a rigged game. This is the second principle of the market operator. The tape reveals the future, but the system is the trap. The wealth of the ordinary investor is no longer in a physical passbook or a stack of certificates. It is trapped in a digital cage, built deliberately not to protect you, but to protect the system from you. Every major reform since 1933 has had the same central unspoken goal: eliminate ordinary people's ability to trigger market panics by withdrawing their money. The first lock is the 401k, sold as a tax advantage, but operating as a massive $7 trillion capital prison. You contribute throughout your working life, yet the second you try to act on your survival instinct, the penalty gate slams shut. Federal tax, state tax, and the crippling 10% early withdrawal penalty for touching your money before age 59 and a half. If you, seeing the storm, try to liquidate $180,000, your money becomes $98,000 before you see a single cent. That is the price of admission to the escape route. But that is merely the toll. The fatal mechanism is the second lock time. You log into your Fidelity app in 2026. You click withdraw, willing to pay the crushing penalty, and your request does not execute immediately. It enters a queue, taking 7 to 10 business days under normal conditions. During a financial panic, when everyone is simultaneously stampeding for the exits, those systems don't just slow down, they can freeze entirely. Imagine the sheer psychological terror of that moment. You watch your savings number shrinking rapidly on the screen, a 30% drop in 2 weeks. You frantically submit the withdrawal request, only to have the system display a simple IC message: withdrawal pending, subject to administrative review. That's not a glitch. That is the system working exactly as designed. In 2008, plan administrators like Fidelity suspended certain withdrawal requests for weeks. Participants logged in to find the devastating notification: temporarily unavailable. Your money was visible, but unreachable, trapped by gates that close precisely when the volatility spikes. By the time your access is granted, the wealth you were trying to preserve will have already evaporated. You have been positioned as the exit liquidity, the last buyers who are forced to watch the value shrink while the smart money walks free. The man in 1929 could grab his cash and run. The investor in 2026 will click withdraw, see a loading screen, and be rendered helpless and unable to act. The exits that saved my generation are sealed. Now, are you ready to see the blueprint of the other digital cages, the traps in banking and brokerage, and the 3 undeniable warning signs that tell us precisely why 2026 makes 1929 look like a rehearsal? That is the real lesson of the tape, and so till they. Now that you understand the blueprint of your digital cage, you must grasp the ghost of freedom that haunts today's markets, the simplicity, the sheer tangibility of the financial world my generation operated within. You must look back at 1929 not just as a crash, but as the last great financial event where the ordinary man, had he possessed the correct understanding of the tape and the courage to act, held the keys to his own escape. This is the vital, terrifying difference, my students. The system in 1929 was brutal, but it was not designed to make you helpless. The system simply let you destroy yourself through greed and hesitation. It didn't physically, legally, or digitally prevent you from saving yourself. Let us dissect the mechanics of freedom that existed then. In 1929, the crisis came from the failure of the institution to physically meet the demand. Banks ran out of money because too many people withdrew too fast. That is a bank failure, and it is brutal, but it is fundamentally different from what we have now. Banks that failed didn't freeze accounts beforehand. They didn't impose withdrawal limits or require supervisor approval for large requests. The destruction came after the withdrawal, not before. Today, the destruction starts before you even get the chance to act. You are prevented from triggering the run. You are simply trapped inside when the roof collapses. The same principle of tangible freedom applied to investments. When you bought shares in 1929, you received physical stock certificates, more ornate paper documents with your name and share count. These were not digital entries in a database. They were property you held. To liquidate, you could find a buyer directly, hand over the certificate, and receive payment, or sell through a broker with settlement in 3 days. 3 days, predictably. This was not subject to trading halts or the indefinite processing queues of modern finance. This immediacy meant investors who saw trouble had options. They could liquidate positions, withdraw from banks, and convert everything to cash or gold. The true operator could exit the market and wait out the storm. The problem wasn't that the system prevented escape. The problem was most people didn't see it coming until too late. Those who hesitated, who believed the reassurances, who waited one more day, were destroyed. Their fate was sealed by their own decision, their own failure to read the tape and act, not by a legal restriction or a digital gate. Even the harshness of margin was transparent. You might have borrowed 90% of the stock price. When stocks fell, brokers demanded more cash. If you couldn't provide it, they sold your stocks immediately to repay themselves. Harsh, yes, but instant and transparent. You knew exactly where you stood. Compare that to today's retirement accounts, where money is locked behind penalty walls until age 59 and a half. Compare it to banks that can freeze accounts for suspicious activity if you withdraw too much too fast. Compare it to investment funds that can legally suspend redemptions during market stress. The 1929 generation faced a devastating crash, but they weren't facing a system designed to trap them. We are. When the crash hit on October 24, 1929, those positioned in cash and gold survived. The survivor in the September story was safe because he had his money and could survive the storm. His freedom came from the ability to simply grab his money and run. That freedom is what was eliminated. After 1929, regulators didn't just try to prevent another crash, they built a financial system that could prevent people from escaping during a crash. Every major reform between 1933 and 2010 had the same core objective: to eliminate the ordinary person's ability to trigger market panics by withdrawing their money. The consequence of this design is that the crash of 1929, which took 4 years to hit bottom because people could withdraw and wait out the storm, will be far slower and deeper in 2026, precisely because you can't. You will watch the number shrink, unable to act. The ghost of 1929 whispers a single terrible warning to the modern investor. When the tape screams danger, your action is meaningless if the mechanism of withdrawal has been replaced by the mechanism of imprisonment. The escape routes have been sealed. Your grandfather in 1929 could grab his money and run. You can't. Not anymore. Now that we understand the lost freedom of the past, we must confront the specifics of the traps that stand between you and survival in 2026, the legal, digital, and administrative barriers that make the simple act of withdrawal a catastrophic, time-consuming failure. Are you ready to dissect the blueprint of the modern cages in banking, retirement, and brokerage accounts? The digital cage, the architecture of imprisonment. You've understood the first truth after 1929. The architects of finance learned what truly breaks the system: freedom. Not greed, not leverage. Freedom. The freedom of the individual to act faster than the herd. So they removed it. Every reform that followed, every law, every protection was not designed to save you. It was designed to save the system from you. They built gates. Invisible, digital, legal. And you, my student, live inside that structure now. The first gate. The penalty lock. The sweetest trap is always sold as safety. They called it the 401k, a tax advantage, a nest egg, a promise of rest. What it became was a $7 trillion pool of liquidity the system can drain without fear, because the capital inside cannot flee. You believe you own that money. You don't. You rent it from the government, and the lease expires at 59.5. Try to act on instinct. Try to withdraw before the fire, and you'll pay for the privilege of survival. State tax. 10% penalty for touching what you earned. Your $180,000 becomes $98,000 before you touch a single bill. The first gate is not built of steel. It's built of hesitation. It makes you ask the fatal question: is the crash bad enough yet? By the time you decide, it will be. The second gate, the time lock. The next trap isn't money, it's time. You log in, click withdraw, and think you're free. You're not. Your request enters a queue, 7 to 10 business days under normal conditions. During a panic, those days stretch into weeks. The system doesn't fail, it pauses. You'll see it on your screen with Warthel, pending, subject to administrative review. That's not an error message. That's design. In 2008, Fidelity froze certain redemptions for weeks. The participants could see their balances, shrinking, bleeding, and could do nothing. They had money, but they no longer had control. Understand this clearly in the new system. Control is the currency, and you've already spent it. The third gate. The physical cash trap. You might think you'll bypass all of this, walk into the bank, withdraw cash, stand free again. But even that freedom has been priced out. Try to take $10,000 in cash. Your bank must file a federal report. Try to take more. They can delay or deny it for review. Withdraw too often and the system labels you a threat. The ATM limits are laughable. $500, maybe $1,000 a day. It's a months-long escape route. By the time you finish your withdrawals, the crisis will already have buried the exits. Remember the Silicon Valley Bank collapse of 2023? Now scale that freeze across the global system, and you'll begin to see the outline of the cage. The fourth gate, the illiquidity trap. And then comes the illusion of liquidity, your brokerage, your mutual fund, your ETF. You think they're liquid because the screen tells you they are. But liquidity isn't real when everyone wants out at once.
March 2020. Over 200 ETFs traded at 20% discounts.
The assets didn't vanish, the buyers did. Rule 22E4 allows funds to hold 15% illiquid assets. When those thresholds are breached, redemptions stop. Frozen. Legal. Approved. The Woodford Fund, 3 years of suspended withdrawals. The REITs of 2008, 18 months before investors saw a cent. The system doesn't have to break, it only has to delay. Delay is death for the operator. Every one of these gates, penalty, time, cash, liquidity, serves one purpose: to convert your pink stylist into paralysis. In 1929, the operator could grab cash and vanish. In 2026, the operator will click withdraw, see a loading bar, and realize too late that freedom has been digitized into illusion. You're watching your number fall, and you cannot act. That, my student, is the design. The cage doesn't close during the panic. It closes before it. Now we move to the final lesson. The signals that tell us the panic isn't approaching. It's loading. You've mastered the blueprints of the digital cage. You know the system's design to convert your instinct to flee into financial paralysis. The penalty lock, the time lock, the physical cash trap, they are all set. The question now moves from structure to timing. Is the panic approaching, or is it already loading? The hum of confidence is still in the air, but behind it, systems are straining, algorithms twitching. The truth is in the tape, and the truth is screaming. A true operator does not guess. He does not listen to the endless cheerleading of the financial press or the analysts who are paid to sell product, not clarity. He relies on cold, hard data, on the patterns of history, and on the silent language of the market. Markets are never wrong. Only opinion is wrong. The opinion today is a poisonous chorus. They say AI will save us. They say trillion-dollar deficits are irrelevant. They say volatility has been conquered by central banks. But the tape whispers something else entirely. It whispers the same fatal delusion my generation believed. The tape shows us 3 signals, 3 undeniable lights, that indicate the system is not merely stretched, but taut, primed for the kind of immediate, cascading failure the digital cage was designed to contain. Signal 1. The historical valuation extreme, the sentiment trap. The first signal is the oldest and most reliable: price divorced from reality. We look at the Schiller PE ratio, the long-term metric that cuts through the noise of annual accounting tricks. It is the measuring stick of market delusion. You don't need precision to see the pattern. You need memory. In 1929, it peaked at 30 before the collapse. In 2000, it rocketed to 44 before the dot-com firestorm. Today, the Schiller PE stands near 39. Understand the cold finality of this number. We are operating at a valuation level higher than 1929, and second only to the greatest bubble in modern history. The historical pattern is simple. When the market begins to believe in permanent prosperity, it prices itself for fantasy, not reality. The 1920s generation thought industrial technology created permanent prosperity. The 1990s generation thought the internet eliminated old economic models. The 2020s generation thinks artificial intelligence has conquered risk. They're all the same thought, wearing different clothes. The extreme valuation today is not a sign of prosperity. It is a sign of sentiment saturation, the moment when all buyers are in, and there is no one left to push the price higher. This is the sentiment trap, the first most visible sign of the bubble's ultimate fragility. The second signal is technical, but its meaning is simple and dire. The debt market is screaming danger. The inverted yield curve, where the cost of short-term borrowing is higher than long-term, is the most reliable single predictor of a recession, and often a market crisis. This inverted curve has persisted for an extended, historically abnormal period. This isn't just a warning, it is the death knell of the credit cycle. An inverted curve is not a chart, it's the heartbeat of credit running backwards. It means banks, the engine of the economy, cannot profitably perform their function, forcing them to pull back, to hoard cash, and to tighten the credit valves that fuel the entire economy. But this time, the crash will be catastrophically faster than 1999 because of leverage and velocity. In 1929, leverage was visible in your margin account. Today, the leverage is invisible, and the speed is inhuman. It is hidden in the dark corridors of the derivatives markets and complex structured products, operating at ratios of 20-to-1 or 50-to-1. Over 70% of market volume is now controlled by algorithms. When the inevitable credit event hits, these algorithms will not pause to consider history or philosophy. They will execute cascading sell orders at the speed of light. This velocity ensures the market falls faster than any human can react, freezing the systems and triggering the very illiquidity traps we discussed. The liquidity mirage vanishes in milliseconds. The 2026 event will be an order of magnitude faster than the slow, agonizing descent of 1929. You cannot outrun the machine, my student. You must position yourself before the machine is activated. The third signal is the most actionable, and it exposes the lie. We follow the money that knows. What is the smart money doing? The corporate insiders, CEOs, CFOs, board members are liquidating stock at near-record levels. They smile on television while dumping stock off screen. They're not calming you, they're clearing inventory. Sovereign wealth funds and institutional behemoths are quietly shifting billions out of traditional equity and bond portfolios and into physical gold and commodities. This is not a market of confidence. This is a market of insider liquidation. I've seen this play before. The smiles never last, the exits always close faster than you think. The insiders, the people who know the true financial health of the system, are quietly heading for the exits while the digital cage is still open. They are selling their own companies at inflated prices, and the ordinary investor is buying it, positioned as the last buyer, the necessary liquidity before the trap snaps shut. The tape doesn't lie. Extreme valuation, persistent yield curve inversion, and the silent massive selling by corporate insiders. All three lights are flashing red. This is pattern recognition, taught through the crucible of market experience. The signal has been given, the cage is locked, the system is waiting. The question isn't if you'll lose, it's whether you'll still be inside when the gates close. The choice is yours, my student. It is time to discuss the actionable steps. How does the modern operator survive a crisis? Where the escape routes have been sealed, the operator's escape strategy. The system has replaced your freedom to flee with digital paralysis. The crash of 2026 is loading. The cage is ready to close. The question is no longer how to predict the market. We've done that. The question is how to survive when every escape route has been sealed. My greatest error, and the error of every man I watched destroyed, was forgetting that the goal is not profit maximization. It is capital preservation. Chasing the last 20% of an overextended bubble is how you end up behind the penalty lock. The survival strategy for 2026 is built on one truth. Position your capital outside the system's points of failure while the system is still calm. The calm you feel now is the silence before the gate slams shut. Action 1. Dismantle the time lock, the exit fund. Your first move is non-negotiable. You cannot withdraw money during the panic.
Time lock will freeze you.
Move the capital that will sustain you before the break. Calculate what you need to live for 18 to 24 months, a typical lifespan of a severe contraction. Move it out of penalty-locked retirement accounts. You escape the illiquidity trap now, not later. You sacrifice yield for immediacy. Marvel. Redirect every new dollar away from 401 calls and IRAs into taxable, instantly accessible brokerage accounts. Yes, it costs you the tax advantage, but it buys you control. The one asset the system has spent decades trying to steal. Cash positioning. Hold your exit fund in ultra-liquid structures, T-bills or smaller credit unions, unlikely to be frozen in a systemic event. To a true operator, cash is not science disciplined. It's dry powder for the panic. He doesn't wait for headlines. He moves when the air still smells like optimism. Action 2. The banking system has been weaponized against withdrawal. The physical cash trap ensures you cannot access serious capital when the system locks. Your only bypass is tangible, skull kicks, physical, gold, and silver. Not ETFs, not mining stocks, not paper gold. The metal itself outside the banking system. Tangible value. Gold is not a belief system, it's an exit code. It is the only asset that is not simultaneously someone else's liability. It carries no credit risk, no digital processing delay. When the dollar trembles, gold doesn't blink. It's the freedom money, the final undeniable assurance that requires no password, No pending review. No 7-day hold. Storage and strategy. Buy from non-bank dealers. Store it in a personal vault or non-bank box. This allocation is your insurance premium against systemic collapse. It is not a speculation, it's sovereignty. Action 3. Once capital is preserved, you can play offense. Adopt the shorting mindset, the mentality that powered my greatest trades. See the market for what it is, a leveraged hallucination destined to correct. Targeted shorting. Find the weak points, the high valuation, debt-bloated sentiment stocks that live off cheap credit and blind enthusiasm. The short is not revenge. It is insurance against the madness of crowds. The long position. When money fails, people don't buy dreams. They buy survival. Your long-term bets belong in energy, utilities, and agriculture, the world's core needs. The sectors that feed, light, and power civilization. These are the survivors when the liquidity dies. The ordinary investor will be trapped behind the gates, watching the mirage dissolve, forced to sell at the bottom because the system never let him sell at the top. The operator, meanwhile, has already built his escape tunnels. The penalty for survival is the appearance of being wrong for 6 months, the cost of the tax advantage, and the effort of physical storage is the loss of a lifetime of capital. Remember the true lesson of 1929. The destruction came not from the crash, but from the inability to act. The exits that saved my generation are sealed. You still have one advantage. We are warning you in time.